Hello, and thank you for checking out another video. Today I want to be brief and talk about portfolio allocations. So in the past, my industry has used a portfolio allocation percentage breakdown of roughly 60% stocks and 40% bonds. Now, every advisor is going to be a little bit different. They're going to throw in some nuanced just opinions on how they construct their 60-40 portfolio. Some people use all U.S. bonds. Some people use a combination of U.S. bonds, U.S. munis, international bonds, and many other things. And then on the 60% equity side, some people use only S&P 500. Some people use a combination of U.S. stocks, non-U.S. stocks. Some people sprinkle in U.S. Passive investing with active investing. Overall, from a bottom line standpoint, my industry uses these allocations to allocate money that goes into the market. Okay. In 401k plans, it's very common that these allocation changes and suggestions would be somewhat automated. So many investors in today's market invest their 401k in an age-based target fund. And as these allocation models change, those models inside of the 401k models will change too. Now, I have no clue how fast that'll happen or when that'll happen. But the old methodology was a 60-40%, 60% stocks, 40% bonds breakdown. Okay, I wrote this down so that you guys could see this. Okay, I know this board is huge. This is the old way, right? 60% stocks, 40% bonds. Pretty simple, right? Not much to it. The other method of going about doing this is kind of more what many people have changed to. I'll pick on Morgan Stanley, has a CIO, Chief Investment Officer. His name's Mike Wilson. He was the first guy I heard to come out with this. This is a mainstream non-gold bug that's coming out with a suggestion for their clients to change to this 60-20-20. So you got 60% stocks, just like over here. You got 20% bonds, just like over here. And then he has added 20% gold to his recommendation for his firm. Now, that does not happen overnight, okay? So just because one guy at one firm suggests a higher gold allocation does not mean that the industry will conform to that overnight. JP Morgan, their private banking division, has increased theirs from 0 up to 5. So every firm is going to react to what gold has done over the course of the last few years differently. Most firms haven't updated this at all yet, but this could be something that we should watch for as investors, because if we can get ahead of a massive US-based portfolio allocation change, it could benefit us as investors. Okay. Now, I'm not saying this is guaranteed to happen. I'm not even saying it's going to happen. Many people have known that gold dampens the volatility of a portfolio for many, many years. It's nice to see that more people are coming to believe that reality. Jeff Gunlock is another guy who has promoted recently having more of an allocation to gold as a portfolio diversifier, and basically just to take out some of the bumps in the road with portfolio volatility. And that's kind of the name of the game. My industry is tasked with a job to give investors portfolio allocations that just smooth out the road a little bit, but still give them an upward sloping, rising return on an annualized basis. The higher the better, but the lower volatility helps people stay the course and be consistent. In my 25 years in this business, I've seen that consistency is by far the most important thing that someone can do to enhance their returns. So I'm not saying that we need to do anything. I'm not saying this is some earth-shattering news. All that I'm saying is I'm seeing glimpses in my industry of the macro model that most advisors use. I'm seeing glimpses of that changing. And when that changes, that's something that you and I would likely want to be ahead of with our own personal allocations. And if we have a small allocation to some of these percentages ahead of when every 401k investor starts to change their ongoing allocations and their current investment mix that they already have invested in their models or their bucket of money that they're saving for retirement, it would probably benefit us financially. So the only other thing that I would say in this is mining. Mining is not a part of this change. I do not see these major firms promoting mining. When I'm saying gold, I'm talking about likely they're meaning a gold allocation like GLD or another ETF that mimics or models the price of gold's current price. So anyways, hope this was helpful. Have a good day and hopefully talk to you soon.